traders, it's me again. You sick of me yet? Trading is risky. Any of these ideas are for educational purposes only. But my intent here is to tell you a little bit about pre-market setups and how to look at gaps and trade them effectively and make your money in the first, 10-20 minutes of the day and be done, especially with options. So for me, good setups are all about extremes, and I like to see pre-market charts with quite a bit of range and price sitting at one extreme or the other. And to me, at the open, wicks are incredibly important. So let's take a look here. And in this example, I marked out the previous day's close. I marked out in this baby poop green color pre-market highs and lows, and then I also just change this because this isn't pre-market. I mark pivots that are around the pre-market areas. So like this would be a pivot. And how do I get those? Well, you always get them looking left. So had I been marking this up, that's likely what I would have done. At any rate, this setup, had I traded it, I would have been looking that we had pre-market all the way up here, price came all the way back down, it opened here and fell, but it's in the bottom part of that range, and then I see this huge wick. What that's telling me is market makers grab liquidity and they're stopping out the shorts right here. Anybody that got short below pre-market range got killed. The minute I see that start to zip up, especially closing above yesterday's close, I know it's a long. And I can take it all off here at pre-market highs, or I may choose to take the majority off and let one ride up to that pivot level from the previous day. You see that? And then I'm done. So that's kind of what a long out of the gate looks like. A lot of range, price is near the bottom of the range, and then we get some kind of signal right here, a big wick, buyers step in, we're off to the races. And then let's look at a trade that was a short at the open, and this is a lot choppier, to be honest, but we're just going to roll with it so I can show you what I'm talking about. First of all, I've got my pre-market colors here, and this actually should be a little higher and a little lower here. Quite a bit of range. We're from 34.27 all the way up to 34.52. So I'm looking at this chart and I would be saying most likely the first directional pick will be short. And then you see the big wick on the top. So this is market makers grabbing liquidity from people who tried to take the breakout of pre-market for a long. You're smarter than that, and you know that indicates a short. So generally, it's not a great idea to get long on the first candle, so you give it a second. You could have gotten short here because it's an under test, but depending on the stock, you would want to give it a stop all the way up here, somewhere above that wick. And you can see, had you not done that, you would have gotten stopped out. In this case, price chopped around quite a bit, but it did come down. Now, where did it come down to? It made it not all the way back down to pre-market lows. So that's, again, where you've got to be good at reading price action. I'm just going to move this because had I been looking at this chart This isn't a closing price, but I would have marked this as a pivot. It's very important with pre-market to mark any pivots, especially in the closing range, like that last hour or so of trading. And what you'll notice is you've got your target all the way here, but if you see that price gets close and rejects and you're in the money, I just take it and run. Okay, that's maybe not the best example, but you get the idea. Wicks at the top, extreme range, you're at the top of that range, wicks at the top, market makers grabbing the long, stopping them out before they take it short. Let's throw Apple here. Okay, here's a decent example of price being kind of mid-range, and then what do? And in this case, there's a lot of range for Apple. And really, the lows are all the way down here based on this goofy candle. I do mark those. Sometimes they come into play. In this case, they did not. But I think they're important to mark. I also mark trend lines. If there's a clear trend, which here there is, off this candle to the 3 candle, I'm going to have that marked. And what I would notice here, there's also a pivot where price kind of leveled out and then busted above. Typically with pivots, price will come back and retest, so I'm going to mark that. And then this would have been, I think I marked the previous day's high. No, highs from 2 days ago. And I got that by looking at the daily chart. You got to start drawing on your chart. I'm not going to go into every single level and how I do it, but most importantly, pre-market highs and lows. Look left to any pivots that you see, especially in the closing range on either side. And then any pivots pre-market. So to me, when price breaks out of here, that's a pivot. And I'm looking for price most likely to come back and retest. And what does it do? It comes back and retests right before the open. So holds that level, that's going to be a long. And where's my target? This particular target, I actually got off the daily chart. Let me just sync that to the daily chart. And it was a close from way back here. Why did I mark that? And I've done this, guys, 1,000 times on live trades. I think what it is you get a feel for a chart after a while and marking areas that you believe price is likely to come and retest. So it just, like anything else, takes practice, right? And in this case, price obviously busted above it, but a lot of times with a gap up, and you can see pre-market roughly where you are, I start marking things looking left that are in the range. And so I would have pulled this because closes are very strong levels for pre-market. And that would have been my target. I also could have used this trend line, the top of the trend line, as my target. So this is kind of a, how do you trade a mid-range? So again, really, these are gaps. Just to review, we had a gap up, a big gap up. How did we know it was going to hold? Well, looking at pre-market, it leveled out at this pivot. So chances are it's going to hold and go. And we can also see on the larger time frame, opened here, came back down and tested, and then took off. And what else do we notice? Oh, by the way, a wick, right? Right below that pre-market pivot. And we also have a wick here, don't we? So that was a gap and retest, but it was so strong really just did that one wick and then moved on up. If something is going to be a gap and go, I just want to show you something really cool on the bigger time frames. Just trying to see, here would be a good example. If you see a level or a shaved bottom candle like this, that's generally a very good sign of strength, meaning it didn't even retest the gap. That's a gap and go. That means natural buyers are there right from the beginning, and the price action is really strong in your direction. The same is true for a short. This is almost a shaved top candle, meaning there were natural sellers right out of the gate. So I will post a list of my rules, but just to reiterate, mark out your pre-market highs and lows, mark out any closing range pivots, mark out pre-market pivots that are obvious, and draw any trend lines that you see. And you want to trade extremes. If you're at the top of the range and you see top wicks pushing price back down, it's likely to be a short, and then the opposite is true. If you see large bottom wicks at the bottom of a range, they're stopping out shorts, and it's likely to be a long. But I will post my little cheat sheet for y'all, and I hope this helps.